Today we have to talk about what options are and how they work. In the text on page 67, we start by comparing a forward long to a call option. We know what a forward long is. It is an obligation to buy an asset, say a share of stock, for a predetermined price at a predetermined time in the future. Let's say there's a share of stock with a price today of 100, and the price for delivery in capital T is 105. As we know, there is no payment in time t whatsoever for entering a forward contract. So the stock price could go up, let's say to 120. Or the stock price could go down, say to 92. If the stock price goes up, the buyer of the forward long profits because he will receive a stock worth 120 and he will have to pay for the stock the forward price of 105. His profit will be 15. If the stock price goes down, then he will lose 13 because he has to pay 105 for a stock worth only 92. Wouldn't it be nice to just say no to the unfavorable scenario of a stock price decline? To be in a position to choose in which situation to go along with the contract or to get out of the contract with no obligation. Such a contract type in which one party has the right to choose is an option. Of course, this right to say no, this right to choose, comes at a price, which we call the option premium. The option buyer would have to pay a premium, just like an insurance premium, to the counterparty, the option seller. Let's say that price is 6. In an option contract, the parties also agree on the exercise price. The variable commonly used is X. The forward price, Ft, was a market price determined by market forces. The exercise price in an option can be freely determined by the parties involved in the option contract. If the exercise price X was also 105, then the option buyer would exercise the option in the high stock price situation and buy for 105, resulting in a profit of 15. But the option buyer paid a premium of 6 in time t, so he would have to subtract that to determine the total profit of 15 minus 6 equals 9. If the stock price goes down below the exercise price, we say the option expires worthless because the option buyer will not exercise it. In which case, the option buyer has only lost a premium of 6 paid in T. The differences between an option and a forward are summarized on page 67. Make sure you read this. Next we will go through some terms and other basics. With an option, one party, we call it the long position, has the right, which implies it's not an obligation, to buy or to sell an asset, which we call the underlying asset, either at a specific future date, which we call a European type option, or within a specific period of time, an American type option. Let's have a quick look on what the difference is between a European and an American type option. An American type option means it is possible to exercise the option during its lifetime. So at any time between T and capital T, the expiration date, the option could be exercised. For a European type option, it means it can only be exercised on the expiration date, which is in T. The price that the parties agree upon to sell or to buy the underlying is the exercise price, which we call X. Sometimes the exercise price is also called striking price or simply strike. The seller of the option is in the short position. So please keep in mind the buyer of the option who has the right is in the long position, and the seller of the option who only has an obligation is in the short position. An option is named call when it gives the right to buy the asset, and it's called a put when it gives the right to sell the asset. So, which also means we actually have 4 basic trading scenarios. We have the position of an option buyer who is always a long position. He pays a premium and he has a right either to buy the asset or to sell the asset. And naturally, the call position, the long position in the call, hopes for increasing asset prices. If he exercises the option at expiration, then he will make a profit. The put hopes for decreasing prices. If the price is low enough, then it might be exercised by the option buyer. The seller of the option or the writer of the option is in what we call the short position. He receives and keeps the premium, but he has no right. He has only an obligation. He must deliver on demand of the option buyer in case of a call option. So if the option buyer says, I want to buy, then he has to go along. So therefore, the option seller in a call is hoping for decreasing prices. The seller of a put option is hoping for increasing prices. Again, he only receives the premium, he keeps the premium, but he will, on demand of the option buyer, take and buy the asset if the price of the asset is low enough, because then the put will be exercised. In which case he will pay the price X, the exercise price for the asset, and receives the asset. To get a better understanding, we have to go through example 5.1 on page 70 and following. We have call and put options on shares of a company, which are given below. We have 2 strike prices, 25 and 30, and we have calls and puts. The call price right now is either 245 or 195, and the put price is 150 or 465. And we will analyze the situation in time 0 for the situation of a buyer of the options and a seller of the option, and we will look at the time of expiration, which is in time capital T, and we will check out 2 price scenarios. Either the stock price goes down to 23 or the stock price goes up to 34. And we will do this in the standardized format in this table for all those positions, which are obviously 8. So let's start with the call long position for the call with an exercise price of 25. The trader who buys such a call, he will have to pay 245 to the seller of the option. So that's his cash flow, negative 245. What happens in 2 months? If the stock price goes down to 23, then the option will expire worthless, and then he has lost the 245, and that's it. If the stock is up at 34, which is higher than the exercise price, then he will exercise the option. He will receive a stock which is worth 34, and he will pay the 25, so he has a profit of 9 from exercising the option. The payoff is 9. His total profit is 9 minus the 245 that he paid, so it's 655. We also would have to look at the break-even point. So what is the stock price where the option buyer has no profit and no loss? the threshold after which he will be in the profit zone. He will start to exercise the option once the stock price is higher than 25, but he also has to recover his premium. So his overall break-even stock price is 27.45. After that, he will be really having a profit. Here we see the first time what the payoff is for a call option at the time of expiration. We will see that, and we will use that very often as minus X. That is his payoff in a call long position, S minus X. Let's look at the short position in a call with an exercise price of 30, which is this one here. So short position means selling the call. Selling the call means receiving the premium in time 0. So the price of the option was 195, so the seller of the call receives that. What happens in 2 months? If the stock price goes down and is at 23, then the option buyer will not exercise the call. The option expires worthless, and the seller of the option keeps the premium and is a happy guy. That is his overall profit. But if the stock price goes up, then the buyer of the option will exercise. The buyer of the option will realize S minus X. We had this before. So the seller of the option is losing that. Therefore, S minus X in parentheses and a negative sign before that. And that, in this case, would be negative 4. 34 minus 30 is 4, and the short position in the call will lose that. He has to deliver a stock worth 34 for 30, and he will realize a loss of 4. But he also received the premium, so he loses 4 because the option will be exercised in this case, but he has received 195, so his overall loss is just 2.05. Also, in his case, we can determine what is the break-even stock price, and that would be 31.95. If the stock is above 31.95, he's losing. If the stock is below 31.95, he's in the profit zone. Let's look at a long position in the put, and let's do this with the exercise price of 30. Buying an option means paying something. In this case, the price for the option is 465. That is what the option buyer will have to pay to the option seller. Let's look at the scenario with the high stock price first. When the stock price is high, then the option will expire. Why? The option gives the right to sell for 30. So if the stock price is high, why would somebody sell something for 30 if he can sell it for 34? That doesn't make any sense. So in this case, the option will expire worthless. But if the stock is low, let's say 23, then selling the stock makes sense. Selling the stock for 30, so receiving 30, and giving away a stock which has a value of 23 results in a profit of 7. The payoff is 7. The buyer of the option has also paid 465, so that reduces his overall profit to 235. And then he's making a profit. Let's determine the break-even. How can we do that? We can do this by putting together the overall position. He will receive 30, he will give away a stock price, and he has already paid 465. And for which stock price is this total payoff exactly 0? And the answer is 25.35. So if the stock is below 25.35, his put position is going to profit. If the stock is higher than that, he will start to lose. Let's look at a put short position. And let's take this one here. Selling the put means collecting the premium in time 0, which in this case is 150. If the price of the stock is high, then the option will not be exercised. We had this already, and then the put short position keeps the 150 premium and is a happy person. If the stock is low, let's say at 23, the option will be exercised by the buyer of the option. So in which case, X minus S is the payoff for the option buyer, which in this case is 25, is the X, and the stock price is 23. 25 minus 23 is 2. That is what the option buyer will win, but that is what also the option seller will lose, and therefore it's minus 2. Since he already collected 150 for selling the option, his overall loss is just 0.5. What is the break-even point? We will make up his total position. He will lose 25. He will receive a stock, and he already received 150. And we ask ourselves, for which stock price will that be 0? The answer is 23.50. So at a price point of 23.50, it's a break even where he has no loss and no profit. If the stock price is below that, then he will lose. If the stock price is above that, then he's fine. It is very important that you study this thoroughly so that you can, for each situation, for a call long, a call short, and a put long and a put short, that you can fill out a table like this. It's important. So look at this. The next thing we have to understand are the terms intrinsic value, time value, and the moneyness of options. We start again with a timeline. A call option on a stock with an exercise price of 105 is available. The buyer of the call option has the right to buy one share of stock at a price of 105. At time 0, the stock is priced 100. As long as the option is running, at any time between time 0 and capital T, the stock price can go up and can go down. The value of the option depends to some considerable extent on the price of the underlying stock. It depends on what the stock price is doing. If during the lifetime of the option the price of the stock is above the exercise price, let's say at some time the stock price is 122. In this case, the option has a theoretical profit if it was only hypothetically exercised. This value would be 122 minus 105 and it's 17. This is what we call the intrinsic value of the option. In such a price scenario, the call option is said to be in the money, which is a good thing. The option is gaining value. If the stock price was just about the exercise price, there's no intrinsic value. But the option is at the threshold of becoming more valuable. In such a price scenario, the call option is said to be at the money, and the intrinsic value of the option is 0. And if the stock price is below the exercise price, his theoretical loss would be 15. But the intrinsic value is also 0 because, and remember that, by definition, the intrinsic value can only be positive or 0. There's no such thing as a negative intrinsic value. In such a price scenario, the call option is said to be out of the money. We can do the same analysis for a put option. The buyer of a put option has the right to sell something at an agreed upon price, the exercise price, in our example 105. The price of the stock is now 100. The value of any option, call or put depends to some considerable extent on what the price of the underlying stock is doing during the lifetime of the option. If during the lifetime of the put, the price of the stock is below the exercise price, let's say the stock price is 90, in this case, the option has a theoretical profit if it was, only hypothetically, exercised. This value would be 105 minus 90 is 15. This is the intrinsic value of the put option. In such a price scenario, the put option is said to be in the money, which is a good thing. The option is gaining value from declining stock prices. If the stock price was just about the exercise price, there's no intrinsic value, but the option is at the threshold of becoming more valuable. In such a price scenario, the put option is said to be at the money, and the intrinsic value of the option is 0. And if the stock price is above the exercise price, the put option is said to be out of the money, in which case the intrinsic value is also 0, because by definition the intrinsic value can only be positive or 0. There's no negative intrinsic value. Actually, there are a couple of different intrinsic value definitions, and that has to do with the time value of money. For practitioners, that is not really super important. Therefore, for us, our definition of intrinsic value is either 0 or s minus x in case of a call, or x minus s in case of a put. So the intrinsic value is just s minus x or x minus s. We can, in our class, disregard other definitions for that. And practitioners, by the way, don't care anyway. So then we can look at some examples so that we get used to what is the intrinsic value. In this case, one is example 5.2, intrinsic value on moneyness. So we can check out what is the intrinsic value during the lifetime of the option, not just at expiration. So then there's the text that you please also look at so that you are familiar with these terms: in the money, at the money, and out of the money. So what can we do with this idea of intrinsic value? We can use that to look at conceptual things like the value of an option. For every option, put and call alike at any given time, the value of the option is the intrinsic value plus something that we call time value. The intrinsic value can be 0 at any time. We have seen that already. The intrinsic value can be 0. The time value can only be 0 at expiration. Why is that? Because during the lifetime of the option, the value of the option can never be 0. So the option always has a value. As long as the option is running, it has always a value. Maybe the intrinsic value is 0, but if the value of the option is positive, which it is, there's always a time value. The time value is 0 when the option expires. Then it's 0. So why is that? As long as the option is running, as long we have not reached the expiration point, there's still a chance that the option can become more valuable. There's always a price to that chance that the option becomes more valuable, even if the intrinsic value is 0. That part of the value of the option we call time value only refers to the time that the option is still running. We will use example 5.3 to practice this a little bit to understand what is the intrinsic value and what is the time value. We have calls and puts, actually quite a few, for 3 different strike prices and for 3 different expiration dates: November, December, January. As we know, the price of the option is always the intrinsic value plus the time value. Let's look at a few scenarios to practice this. The call for November 115, the option price is 150. What is the stock price right now? Let's check out the example. The stock price today is 113. So as we know, the intrinsic value is S minus X, in which case that would be negative, but there is no such thing as a negative intrinsic value, so the intrinsic value is 0. But the option price is 150, so that must be 150 time value. The option price exists only of time value. Let's look at the put in November. The put 110 is priced 140. The intrinsic value for a put is X minus S. X is the 110, S is the 113. That would be negative, so it's 0. The intrinsic value is 0. The price of the option is 140, so the time value is 140 because the option price exists only of time value. Let's take the call for this. Let's take the call here, the 5th one, 105. So 105 strike price for January. That price is 1150. The option price is 1150. The exercise price is 105. So the intrinsic value is S minus X, and that would be 8. The option price is 1150, 8 of which is intrinsic value. So the rest must be time value. 350 is the time value. And we can look at the put option for 115, which is the January put for a strike price of 115. That is a price of 556. That's the option price. The intrinsic value is X minus S for puts, which is then 115 minus 113, that is 2. So in the option price is an intrinsic value of 2, and all the rest must be time value, which is 356. Please go through this for all the options so that you practice this. Here, this is only 6 scenarios, 6 of them, but as you see, it's 18 different prices. So please check this out for all of these scenarios. The last thing for today is to look at payoff diagrams. Payoff diagrams, sometimes referred to as profit profiles, so it doesn't really matter how we call them, payoff diagrams, profit profiles, whatever. And we start by looking at the profit profile of a call long. What do all these graphs have in common? The x-axis is always the price of the underlying at time capital T, at expiration. And the y-axis is always the profit or the loss for the position. So we may interpret this as like a Polaroid photograph for time capital T where the option expires, and then we like to see for which prices in the underlying we have which profit or which loss. Because the stock price can be anything between 0, that would be this point, and very, very, very high up in the air. But it's still only a static analysis. What is going on profit-wise or loss-wise in time capital T? At time T, the stock price could be just exactly the exercise price, which would be this here, the X. In those profit profiles, we will look at profit and losses, which also means anything up here above the x-axis, good, because it's profit. Anything below the x-axis, bad, because it's loss. Since the stock price can be anything between 0 and high up in the air, it can also just be X. If for some reason the stock price is just exactly X, the exercise price, what does that mean for the call long? It means the call long, the buyer of the call, will not exercise the call. So for a price of X, his loss is the premium that he paid in time 0. So this would be this point here. And for any price that the stock will have below X, the option will not be exercised. This horizontal line represents the loss of the call long position for each and every stock price below X at time capital T. But if the stock is higher than X, then the option will be exercised. It will still not be in the profit zone, but it will reduce the losses to exercise the option. So we can also say if the stock price is above X at time T, then the option will be exercised. And for each €1 that the stock price is higher than X, there's €1 more profit in the option. Then we have this point here, which is obviously the break-even point. This is the point X plus C0. Why? Because this is the stock price that is so high that it covers the cost of the option, and then that's the point where the option buyer has no profit and no loss from buying the option and exercising it. But if the stock is even higher than that, then there is a theoretically unlimited profit potential for the option holder. From examining the profit profile, we can see what is the maximum profit at time capital T, which in this case is theoretically unlimited, minus the premium paid in time 0. What is the maximum loss? The maximum loss is the premium paid if the option is not exercised. What is the break-even? The break-even is X plus C0. And what is the exercise point? That is this point here, when the stock has reached X and is a little higher than the option will be exercised. Let's look at the profit profile for a call short. Obviously, this is just a mirrored image of the profit profile for a call long. If the stock at time T is exactly at X, then the option will not be exercised, and then the seller of the option is a happy guy because he keeps the premium. And that goes for each and every stock price below X because the option will not be exercised, and then the call short position keeps the premium, and that would also be his maximum profit. For each and every price above X, the option will be exercised by the option buyer. And then the option seller will lose until his premium is actually eaten up. And for even higher stock prices, he will be losing something. So again, we can determine the maximum profit, the maximum loss, which is in this case theoretically unlimited, the loss, the break-even point, which is this one here, and the exercise point, but the call owner will exercise. The seller has no right to do anything. So let's look at a profit profile for a put long. So what is it that the put owner has? He has the right to sell something. For which price would he sell at X? For low prices in the underlying. So he profits from low prices and then he will exercise his option to sell. If the price of the stock is high, then he will not exercise his put, and then his loss is limited to the premium that he paid, which is P in this case. And that would be his maximum loss. If the price of the stock is below X, then there will be a break-even point so that he earns back his premium that he paid. And if the stock is even lower than that, then he is actually having a profit. And the maximum profit is, of course, the price for which he sells. If the stock is 0, he's selling it for X. if at time t, which is a very theoretical situation, the stock price is 0, then he would sell that worthless stock to the seller of the put, and he would get X, and he would subtract from that the premium that he paid. So this point here is his maximum profit if the stock is 0. So, and we can look also at the profit profile for the put short position. The put short position is selling the put, so he receives money. That's the reason why the horizontal line is in the upper half of the diagram, because he's getting something from selling the put, and he will keep that if the stock price is high in time t, because then the option will not be exercised, and then that would be good for the seller of the option. But if the stock price is low, the option buyer will exercise it, and then the seller of the option will lose. He will eat up his premium that he collected at the break-even point, which is this one here. And then if the stock price is even lower than that, maybe even 0, then he will lose. He will have to buy something which is worthless for a price X. He pays X. He receives something that has no value. So my recommendation would be to look at all those 4 scenarios so that you are familiar with the profile, particularly to see, all the data points that are above the x-axis are good because they mean profit, and all the data points below mean losses. We have to understand that this is just like a Polaroid photograph of a situation in time capital T, so that we can see for each and all those possible stock prices what is our profit situation or loss situation. The next question is, for what can we use this? And that is something that we have to look at real quick, just to get a basic idea how we can use this. For that, we will go forward to the section that we will discuss in the next lecture, which is about the strategies. So let's look at this real quick. Those strategies that we will discuss can all be pictured in such profit profiles. For now, it's a nice thing that we can use the payoff diagrams to understand the strategy, even if we still do not know how to set the strategy up. So, for example, let's look at something that is called a long straddle. The long straddle is a combination of calls and puts. And the result of such a thing would be the thick line here. So this thick line, what does it tell us? If the price of the stock is between this point and that point, then we will lose something. If the price of the stock is above this point, we win. If the stock is below this point, we also win with this strategy. What does that mean? It is a strategy that we could employ if we expect the stock price to have a high volatility, to either go up a lot or go down a lot. Because if it stays around the exercise price of X, we will lose. So that is a strategy that profits from a high volatility in the stock. And we do not even have to understand how to set it up. To understand, a long straddle is a strategy that wins when the stock price is low or when the stock price is high. And the short straddle is just the opposite, because here we see the thick line is above the x-axis for stock prices around X. And if the stock price is high or the stock price is very low, then this position will lose. So this is a strategy that could be employed if a trader expects stock prices not to move much above X or below X. So for a low volatility strategy. A strip. It looks a little bit like what we had before. A strip. So we have actually 3 options that we use for this. And what do we see? We see a strategy that pays a profit for higher stock prices, and it pays a profit for lower stock prices, and it loses if the stock doesn't really move, because then we are below the x-axis for all the stock prices between this point and that point. But since there are two puts being used, it is here that we, for each €1 that the stock price is below X, we make €2 with the options. So this is a strategy that profits a lot more or quicker from declines in stock prices. So we can use the payoff profiles to look at a strategy, to picture it for time capital T, to see for which stock prices or for which prices in the underlying will we have a profit and for which will we have a loss. We are at the end of this session. Any questions can be written in the comments if you like. Once I see them, I'll answer them for everyone to see and profit from it, or you send the questions via email to my known email address. Then, see you and peace out.